Common management definitions. Shark Tank Edition. Pitch is a presentation made by entrepreneurs to the sharks or investors to persuade them to invest in their business or product. Valuation is the estimated monetary value of a business or product. Entrepreneurs often negotiate the valuation of their company when seeking investment from the sharks. Equity is the ownership stake in a company. Entrepreneurs offer equity to the sharks in exchange for investment capital. Equity stake is the percentage of ownership that an investor holds in a company. Investment is the money provided by the sharks to fund a business in exchange for equity or a return on investment. Deal is an agreement made between the entrepreneur and one or more sharks to invest in the business. Royalties are payments made to investors based on the revenue or profits generated by a product or business. Intellectual property or IP refers to creations of the mind, such as inventions, artistic works, designs, and symbols, for which exclusive rights are recognized under law, enabling the creator to control their use and distribution for a specified period. Licensing agreement is a contractual agreement between a business or licensor and another party or licensee, granting the licensee the right to use the licensor's intellectual property such as a product, brand, or technology in exchange for royalty payments or other compensation. Due diligence is the process of investigating and assessing the financial, legal, and operational aspects of a business before making an investment. Projections are financial forecasts and estimates of future revenue, expenses, and profitability provided by entrepreneurs to demonstrate the potential growth and success of their business. Exit strategy is a plan outlining how investors or sharks will eventually sell or divest their equity stake in a company to realize a return on their investment. Contingency are conditions or terms that must be met before a deal is finalized or investment is made. Contingencies may include achieving certain milestones, securing additional financing, or obtaining regulatory approvals. Leverage is the advantage or bargaining power that entrepreneurs or investors have in negotiations, often based on their assets, reputation, or alternative options. Follow-up is the post-investment process where sharks provide guidance, mentorship, and support to the entrepreneurs to help them grow and succeed. Counter or counter-offer is a response to a previous offer made in a negotiation or business transaction, typically proposing different terms or conditions than those initially offered. It serves as a negotiation tactic to address concerns, suggest modifications, or propose alternative terms in an attempt to reach a mutually acceptable agreement between parties. Gross margin is the percentage of revenue that exceeds the cost of goods sold. It measures how efficiently a company is producing and selling its products or services, excluding other expenses. Higher gross margins indicate better profitability from core operations. It is calculated by this formula: EBITDA or earnings before interest, taxes, and amortization. It is a financial metric that measures a company's operating profitability before accounting for interest expenses, taxes, and non-cash items like amortization of intangible assets. EBITDA equals net income plus interest plus taxes plus amortization. Shark Tank effect is the phenomenon where exposure on the show leads to increased visibility, sales, and growth for the entrepreneurs and their businesses.